So volatility has remained high in the financial market. So today we have some statistics on the stock market sell-off. We're also going to check in on corporate profitability. This is the most important thing in the long run for stocks. We've got some latest numbers there. And lastly, the jobs market. Very important for consumer spending. We're going to look at 3 numbers that came out this past Friday. Let's dive into it. So first off, I want to mention, with so much going on in the financial markets right now, it is important, if you are not a subscriber, to go ahead and subscribe and turn the notification bells on. You don't want to miss any of these updates. All right, today we're going to talk about the stock market. The volatility has remained high. The selling has continued over the last week, or at least for most of it. The first thing I want to say is, if you didn't watch our video that we came out with last week, go watch it. We have a picture here, a link that you can click on. And the reason it's important is, in that video, we mentioned that since the start of 2023, this is now the 5th sell-off of significance. This is not new. We've had this 5 other times, and yet over that time frame, it has been a very good time to be an investor. The market has gone up a lot. Volatility is just part of the deal. So go watch that video if you haven't already. All right, let's talk about some statistics, because right now the S&P 500 is off a little bit over 7% from its high from February 19th. Small caps down almost 17%. They are kind of the leader with the decline yet. Tech companies down 12%, and a lot of the individual names are down a lot more than that. It has been rough to be tech. Now, an ETF we like to follow is a momentum ETF. The largest holdings in it are Amazon, Nvidia, Meta, Berkshire Hathaway, Eli Lilly, JP Morgan, and Costco. So companies across all industries in this fund. We're going to put the chart up. This is going back 1 year. At its low last April, it was trading at $74 a share. It raced up and peaked at 91 last July, and look at that sell-off from 91 to 79. That's about a 13% decline that happened at that point. Then it was off the races, 79 up to 103 in mid-December. That was when we had the video where we said, hey, we're starting to see some signs of froth in the markets, a little bit of euphoria. And lo and behold, from that point to today, it's dropped from 103 to 91, a decline of also about 12 or 13%. So the point is, over the last few weeks, we have had a sell-off that was very similar to the sell-off we had last summer. That was a painful 2.5 weeks, but yet it was a great buying opportunity. We believe that's going to be the case yet again. So in just a second, I'm going to show you probably the most important chart in today's video, but I want to start by checking back in on a topic we addressed a few weeks ago, which is fourth quarter earnings growth. Coming into this year, expectations were company profits in the S&P 500 were going to grow at about 12%. When we last visited and touched on this topic, expectations had moved up, because we had heard from most companies at that time, to 16.8%. Well, look at this. If we look at this as of today, with most companies having reported, it is now growth up to 18.5% corporate profit growth for the fourth quarter. That is phenomenal. You does not get much better than that. And the important thing is, profit growth has happened across almost all industries except energy. Energy had a 26% decline year over year. So if you take that out, growth is greater than 20%. That's exactly what we want to see. And we talked about the fact that corporate outlooks for 2025 was some of the best we have ever remembered. And that was, again, across all industries. So look, we won't start to find out how companies did in the first quarter and what their outlook is for the rest of the year until about mid-April. That's going to be a very important time for the markets. But this is good news. Growth now expected to be over 18.5%, up from 16.8% just a few weeks ago. All right, let's talk about what I think is the most important chart in the video today. And this is taking a look at analyst estimates for profit growth. And let's look at this. And what you'll notice, 2023 is now in the rearview mirror. Corporate profits were for $221 in the S&P 500. 2024 is just about done. Well, it is done, but we've heard from just about every company. Growth jumped all the way up to $246 of profit growth, so that's very good. But look at 2025. Right now expected to be $270. If we get that, that will be a very good year. 2026, we're still a ways away here, but notice that's expected to be up at $309. That's another big jump. But let's look at the red line, because that is looking at the coming 12 months. And notice, ever since early in 2023, this has been steadily rising. And guess what? Like we just talked about a few minutes ago, the market since early in 2023 has done very, very well, albeit with 5 significant sell-offs thrown in along the way. So we're going to be watching this red line closely. We want to continue to see that rise, because if so, in the long run, the stock market is going to head that way also. Now let's check in on the jobs market, because it's very important that the jobs market be pretty strong, because this is what powers consumer spending, and consumers make up 70% of our economy, 70% of GDP. So we watch this closely. Last Friday, we had the jobs report for February. 151,000 jobs were created. That's not as good as they averaged last year, over 200,000, but it still is a pretty strong report. When you look at sectors and job gain / loss per sector, you will notice that healthcare and social assistance led far and away with over 60,000 jobs added last month. And you can go down the line there. You see finance, insurance, and real estate. Construction had jobs growth, transportation and warehousing, and you can go down. Notice the highlighted number, federal government. We all know that there have been a lot of layoffs at the federal government level, and you can see that here, that there were job losses, net job losses in that part. Now, we like to go beneath the surface of some of these jobs reports and also look at other data sets too. And in the jobs report, we have average hourly earnings. And notice this grew year over year, over 4% for wage growth for consumers. This is very good. If you take a look, this has now been pretty steady for the last, 6-7 months after last summer. This was on a downward trajectory. A lot of people were worried about this crashing. That has not happened. It is on an upward trajectory now. And take a look at where this was pre-COVID, 2016 through 2020, or up until 2020. And notice that this number was 2.5%, 3%. So wage growth of 4% is perfect. We don't want to see this at 5 or 6. That is inflationary. The Fed's going to be concerned about it. We don't want to see this at 1 or 2. So 4 is in kind of a perfect level. This is good news for consumers. Now, this is if consumers have jobs. They can get these average hourly earning gains. But let's check in and see what's happening in the layoffs department. Last week, we got initial claims for unemployment insurance, and this comes out weekly. So the jobs report's once a month. So this is almost real-time data. This came in at 221,000, and it had been 242 the week before, and some were worried, especially the people that are always calling for an imminent recession. They thought this was going to go up to 250, 260, and off to the races. That did not happen. It dropped back to 221. And you can notice there, this has now been in a range for 3 years. And all along that time period, consumers have been spending money. So the good news here is there are some layoffs happening at the federal level, but there's not many layoffs happening on the private level. And some of the people being laid off are able to find jobs quickly. This is very good news for future consumer spending. So not everything is good in the jobs data. From the jobs report last Friday, we are looking at total private average hourly earnings. And this is looking at, you got to separate what's happening at the federal level and state and government level. This is working at the private sector. And this is how many hours are being worked each week. And notice that this came in at 34.1. That's, by the way, the same as it was the previous month. But this has been in a steady downtrend since 2021, consistently going lower. And it's now kind of broken below its range of 2012 to pre-COVID levels. So we're going to be watching this in the months to come. We don't want to see this continue to go lower, okay? We want a lot of hours worked per week for employees. That's what they're wanting. And we wanted to show you this because, again, not all news is good news on the jobs front. Most of the news is positive. This wasn't. Okay, so to recap, we talked about the fact that the market has been volatile yet again. Stocks have gone lower, but this is not unusual. And we talked about last week's video is so important to see because we put this sell-off into context. We also looked at profit growth and the fact that the fourth quarter profits are now up to 18.5% growth year over year. That's exactly what we like to see. And analysts are continuing to raise future year profit growth. The markets go higher over time when profits go higher. We looked in at the jobs market. Not all news is good there. Weekly hours worked in the private sector have been trending lower the last couple of years, and that continued. But in general, we had over 150,000 jobs added. And if you break down and look at initial claims for unemployment insurance, those continue to be very low, meaning there's not many layoffs happening, especially at the private sector level. Thanks for watching. Take care. Thanks for watching our video. And listen, if you are new to Sentara Capital, we know that there's a lot of craziness going on out in the markets right now. And we also know that most of you are not getting market updates from your advisors, especially not at the big banks, where most of the time you're just a number. Well, that's not the case here. Give us a call, reach out to us. You can go to sentaracapital.com and go to the contact page. We'd love to have a conversation with you and see if you're a good fit. Thanks for watching and take care.